Welcome, financial professionals. I'm Todd Scott, Regional Vice President here at E4 Insurance Services, welcoming you to the Brew, building relationships every week. Thanks for tuning in. For those of you joining the Brew for the first time, welcome. We like to start the Brewcast by celebrating today's national days. Today is National Cheese Curd Day, and today is also World Students Day. Today we are continuing October's lineup on leveraging the power of annuities. I'm here with Doug Twiddy, Director of Annuities here at E4, to discuss different types of annuities and more. Thank you, Doug, for joining me today. Doug, I will hand it off to you.
All right, we'll jump right into it. So this is kind of more of an annuities 101, right? Scratching the surface, seeing what all is out there. Hopefully for advisors that are trying to get more into the space, get comfortable with it, sort of figure out where they can go to look at things. And we actually have a great 2-page piece, even for seasoned annuity advisors. Just a nice little cheat sheet, kind of keeps you up to date on some top rates, but it's all compact, easy to read. And I just wanted to kind of skim through that. So every Monday, we send out this updated Annuity Solutions Weekly in an email. So first off, if you're not getting that email of Annuity Solutions Weekly, please reach out to your RVP and make sure that you're put on the list to receive that email. Also on top of that, it is available from our website. And because our website has so many other great tools, that's kind of where I'm going to go with sharing for this particular setup. So if you haven't registered to our website, please do so at advisors.e4.insurance. Once you're in there, you'll have access to basically everything, any contracting applications, some nice sales concepts, and quite a bit more. But from the dashboard, under the Annuities box, we have the Annuity Solutions Weekly link. Super easy. When you open it up, you can just download the current Annuity Solutions Weekly from whatever the previous Monday on it was. So now that we're in, we will just zoom in a little bit to make sure everybody can see. Todd, is that good enough?
Looks great.
All right. So we go through all the different types of annuities. Annuities are just different vehicles, different places that you can place money, qualified, non-qualified funds, for a safer accumulation in most cases. So we start out with MYGAs, multi-year guaranteed annuities, very similar to CDs at a bank, right? Except you get compounded interest inside of an annuity versus a bank with a CD. You get hit with the taxes every year on the gain. So with a MYGA, nice, easy layout, right? We show 2, 3, 4, up to 10, right? Sometimes the numbers will change a little bit, kind of depending on what's competitive at the time. We don't get all, 9 in here. But just to explain sort of what we're looking at, right? It's the years that are guaranteed. We show the carrier and the product, pretty self-explanatory. Remember, just because it's a carrier that you don't know, that you haven't heard of, doesn't necessarily mean that they're super new. We do a lot of homework into the carriers that we get contracted with and that we offer to our advisors. We do look at a lot of their financial backing, their strengths, their investments, their reinsurance. All right, we try to do our homework so that hopefully we are providing carriers that are going to be strong and hold through the time that you need them, and hopefully you're not going to have any kind of awkward conversations with your clients. Obviously, we can't guarantee any of that, but we do the homework. So just because you see something like Exonic or America or Ocean View and you haven't heard of it, get with us. We can give you more info if you're looking for it. The product name, I'll come back to this in just a minute. The ratings, we really only deal with one B++ carrier, and that's Equitrust, but they are supposed to be moving up to A-. So hopefully we'll be seeing that come soon. And then to skip over real quick, right, we're showing the rate. So this is the annual interest rate that you're going to get. And in order to get this interest rate, you have to have the minimum premium of 70, 100, 25. North American's top rate is 250,000, right? So you'll at least get to see the premium that you need in order to get the rate that's shown. Then most annuities have some version of liquidity to them, right? So with the free outs, that's kind of what we're showing. And there's a forward slash on here. So on the left side, you see how much free liquidity you have in year one. And sometimes it is zero, okay? But after the forward slash, that's the free withdrawal privileges that you have after the first year. So in this case, it's only year two, but in here, it's years 2 through 10. The max age to get this particular rate, some carriers don't offer rates to older people. We have other carriers that go up to age 100. So again, just because you don't see it on here doesn't mean we don't have it. Please reach out. Effective date, that can be somewhat important sometimes when you see rates changing a lot, when interest rates are moving around, treasury rates are bouncing, and you see a rate that's old, that might move soon. All right. Everybody else has moved and they haven't. So I would expect to see those changing potentially next. But that's the basis of the MIGA. To come back to this weird circulating arrows of a circle, we show that this is the number of years that the rate's guaranteed. At the end of the guarantee period, most annuities, not all, we have lots that don't do this, right? But a lot of annuities will do something that we call auto renew. And they'll generally give you a 30-day window before the end of the period or after the end of the period, a 30-day window where there's no surrender charges, and you can pull the money. If you don't pull your money during that 30-day window, these circulating arrows tell you that this product auto renews. And in this case, they all do. So if you miss the 30-day window, it's going to renew under surrender charges for another period of time. Generally, it's the same years that the original rate was guaranteed. However, this rate is not necessarily guaranteed for that second renewal provision. Some advisors don't like the auto renew at all. They like to stay away from it completely. We do have a system where our database will automatically email the advisor and the RVP 3 times before it's going to auto renew. Plus the carrier sends a notice to the client, which they probably won't look at, as we know. And they're also supposed to send a notice to the advisor, letting them know. They generally send it about 45 days out. But that's the auto renew feature. So if you see one that doesn't have it, it means that at the end of that guaranteed term, there are no more surrender charges. They'll offer a new rate for the following year, and you can keep it if you want. You can hold it for 6 months and then pull it out. You're free to do as you please, right? And the interest is credited daily. So for every month or so afterwards that you leave it there, you do at least get a little bit of extra money. And that's the basis for the MIGA, right? So every Monday, this goes out and shows you the top MIGA rates, at least as of that Monday. In the email that goes out, there's also a bunch of bullet points that generally show any upcoming changes on rates that you need to be made aware of. So at least in the email, you might see that, say, Exonic's 5.55 rate is changing on Wednesday. So that's important because if you're looking at this on a Thursday, well, that rate doesn't work anymore, right? So make sure you're on the email, please. Any questions on it, Todd?
I'm good so far.
Keep on rolling. All right. So now we move down. Maybe a client wants a little bit more than 5%, right? They want a better option. They're willing to be a little bit more aggressive. You can't be but so aggressive in a fixed annuity, right? Or a fixed indexed annuity, but maybe they want the ability to earn more than 5%, and they're willing to sacrifice possibly not getting anything in a down market in order to possibly get, say, 10-ish% when the markets are good. So inside the green section are our fixed indexed annuities, and this gets broken up into 2 sections. We generally deal with just the allocation, the index of the S&P 500. Some advisors look outside of the S&P 500 and want to look at a hybrid indice. We can have that conversation all day long if you want to, and sometimes we'll show them down here. But for the S&P 500 specifically, we always show the best 5, 7, and 10-year S&P cap. So as of yesterday, in this particular case, Aspida's Wealth Lock Accumulator 5 had an 11% cap on the S&P 500. That's a 5-year surrender charge period. You get no free withdrawal privileges in year 1, but you get 10% free withdrawal privileges after the first year. You can't buy it if you're older than 91, and you need a $100,000 minimum premium in order to get that cap. All right. On the last column, if there's something available, we'll throw a little extra piece in there. In this case, Aspida has a 5% bailout. That means that, we can't guarantee the 11% cap for all 5 years. We do look at rate integrity of carriers as best we can. But if the carrier decides to lower the cap, if they lowered it below 5, they would have to waive surrender charges so you can take your money and run. Gillico has a 6.75 bailout cap. A lot of carriers don't have bailout caps. So the fact that they have them is actually really, really nice. Aspida's fixed index annuity is a little bit lower. They've done really well so far with rate integrity. Gillico has incredible rate integrity. They've got 100% rate integrity running 10 plus years now, I think it is, which means that they have never lowered the cap on a client after the purchase of a product with this line. All right, so 10.75, while we can't guarantee it's there for 7 years, you can feel pretty confident that it's going to, at the very least, stay close to it because they've never dropped it before. National Life 10-year product, again, without being able to guarantee the cap for 10 years, that can be a little iffy, hoping that a carrier stays strong for 10 whole years. But National Life has done really, really well with their S&P 500. For the most part, it's basically stayed exactly where it's at since issue. They've even got some that have increased. So, again, like I said, we do try to look at rate integrity. And in this case, you only need $20,000 or $25,000 to get that rate, right? So, in case you don't know, S&P cap, super easy calculation. Policy issues today, they look at the S&P 500's index value today. 12 months down the road, they look at the index value again and determine how much it went up. If it went up 5%, you get a 5% return. If it went up 9%, you get a 9% return. If it went up 15%, you're capped at 11, right? Or you're capped at 10.75. You can't get any more than the cap. But because it's a fixed indexed annuity, you can't lose money due to market loss. So if the S&P is down, you get 0, which sounds bad. You could have gotten 5.5, but you can't lose money in a fixed indexed annuity outside of if you had a fee applied to it. None of these have fees. There's no product fees. We're not showing anything with allocation fees, nothing like that, right? Pretty basic, nice and simple. Outside of an S&P 500 generic cap, we will show 3 other options that could be interesting. A lot of times they stick to the S&P 500 still, just because it's a great index to run with. Sometimes we'll show something else, though, if we feel that it warrants it. In these particular cases, we're looking at things like a biennial point-to-point, which simply means it's over a 2-year span, right? And this product comes with a 10% day 1 premium bonus. So you get a nice bump guaranteed on day 1, and then you can get up to 15.5% every 2 years. That's the cap on it. Interesting one on this, it's a 3-year fixed indexed annuity. So it's not a super long surrender charge period, right? And it's uncapped 60% participation each year. But when the market's moving really, really strong, when it's doing 20, 30%, it'd be nice to get a 60% participation on it. And oddly enough, on the fixed indexed annuity side, we do have a fixed rate down here in other interesting ideas. Ocean View's Harbor View 10, they have a guaranteed 9% fixed interest rate for year one. It's not going to stay there after that, but if you're looking for a nice, strong return in year one, that's a good option. They also have really good S&P caps to roll to after that. So that's it for fixed index annuities. Todd, any questions on that?
I'm good on that.
All right. Keep on going. Still on page 1. Of course, within annuities, we have SPIAs. SPIAs and DIAs. It's basically throw in a lump sum of money and produce an income stream. These are all fixed products, right? There's no indexed options to it. So if you got a broker dealer you have to do compliance with, this is an easy option to run to if you want to produce income. On a SPIA, it doesn't have to be guaranteed lifetime income. We're not talking about retirement income necessarily. We can produce a set number of years, right? We can fund a SPIA to produce an income to pay a life insurance premium when you're doing say a 5-pay, 10-pay, 20-pay. We could do something to offset. I've seen somebody do offset mortgage payments. He wanted to basically make mortgage payments for his son, and he handled it through a SPIA. But here we are strictly looking at a 10-year period certain. So if we threw in $100,000, how much money could we get per month or per year for the next 10 years? Income basically on day one. So we're showing 5 carriers, monthly income, annual income. And we do Medicaid compliant SPIAs, and that's where the 3 superscript comes in. So we have a couple of different carriers that can do it. Penn Mutual is the only one in the top 5 for this case that will do a Medicaid compliant SPIA. So if you deal with clients that are in crisis planning and they need to get into a Medicaid compliant facility, but they have too much money and they can't qualify, Medicaid compliant SPIA can be a great option to shift that money to the side and not have to lose it, and it comes back to the spouse and allows them to qualify for Medicaid the next day. So if you want to have a conversation, feel free to give me a call. We can run through that all day long. Now, I think one of the bigger products that we've been, or I shouldn't say products, strategies that we've moved to a lot this year, kind of away from MIGAs because the rates have been coming down a little bit, are our annuities with guaranteed lifetime withdrawal benefit riders. In most cases, these are done in a fixed indexed annuity, but we do have the ability to do it in a fixed annuity. So again, if you're dealing with broker-dealer compliance, we do still have options. But we're dealing with people that are either looking for single or joint lifetime income, and it could be either starting 30 days from now or any period of time in the future. So a nice cheat sheet here is looking to see how much lifetime income can you provide your client, a retiree, right? Give them a base for retirement income to cover any essential spending needs that they have. So in this case, $100,000, and just to explain the grid so you can easily use it with clients. And if your client has 200,000, just double the numbers. If they've got $1 million, multiply it by 10. It works that easy, right? We don't deal with, wholesaling type numbers. There's no discount per thousand by doing more premium. So a 60-year-old single person, right, joint person. So a 60-year-old single person with 100,000 looking for lifetime income today would get $7,000 a year. If they could defer income soon, right, 5-year deferral, if a 60-year-old could defer to 65, that single person could get $11,000 a year. If they could defer to 70, they get $17,000 a year. And of course, I'm rounding here, right? But if a joint, right, you see the same numbers. If they're 65, doing the same thing, single income now, joint income now, 65 deferring 5, deferring 10 years. and of course, age 70 doing the same thing. All right, so we could potentially, just off of this grid, we could do things like give 19.7% of the original premium guaranteed for life. Right, so a 70-year-old deferring income till age 80 would get nearly 20% of their premium guaranteed every year for life. Nice, easy grid to look at. This can be done with non-qualified and qualified money. Right, we can do joint lifetime income with qualified money. So even if the owner of the qualified funds passes away, the spouse can continue taking that lifetime income until they pass away. So, great option. Feel like I flew through that really fast, though. Does it all make sense?
All makes sense.
All makes sense.
Very interesting. Very good options.
The next two go by pretty fast. So, long-term care planning. We do a lot of long-term care planning, but the industry's changed a lot. People don't like the idea of long-term care. They generally think nursing home, hardcore care. They're never going to need it. My children are going to take care of me. My spouse is going to take care of me. I'm going to stay in my home, whatever it may be, right? They don't like the idea of thinking about long-term care planning. Plus, they also don't want to pay a premium for something that they don't think they're ever going to need. They don't want to spend all this money and have lost it if they never needed long-term care. They'd rather just keep a little bit of a cushion aside. And if they ever needed long-term care, they tap into that cushion. Right? And I get it. However, we can take that cushion and we can do better things with it. So these are 4 options. We have more than 4. I'm not really going to touch on, I guess I'm not going to touch too much on detail for any of them, but I'm not going to go down to these 2. Some of the ones we use the most, or the one that we probably use the most, is Global Atlantic 4Care. I'm going to touch on a couple of points here because it really is an incredible product. It's an incredible annuity. You can move, again, in this case, it's $100,000 premium, male age 65. You get 2 times to 3 times your premium as a benefit pool. So you move in 100,000, get $300,000. There's a few medical questions. It's like 8. There's not a lot. It's actually pretty easy to qualify for. But you can get $300,000 worth of long-term care coverage immediately. The interest rate applied to this fixed annuity right now is 5.5% or 6%, depending on your premium. The 4Care product has been around for quite some time, and they have nearly 100% rate integrity on that fixed rate. I just went back earlier today. I looked at the very first 4Care product that we sold, which was only 6 years ago, and it still has the same interest rate that it was issued with. All right, so Global Atlantic told me that there was a small grouping, a small age band that they made an adjustment to one time. Outside of that, they've never lowered the interest rate after someone bought the 4Care product. So the benefit pool is going to grow based on that interest rate, which is why this isn't $300,000. Even if the interest rate does decrease, let's say it drops all the way down to its bare minimum, the 4Care product guarantees that that internal cost of long-term care will never be higher than the interest applied, meaning your account value will never decrease due to the cost of that long-term care. So take $100,000, turn it into $300,000 of long-term care, guarantee that the $100,000 grows because it's absolutely going to grow in year 1, right? And then it will never go down from there. And if you ever need long-term care, it'll give you $4,300 a month for 72 months. If you don't need long-term care, it's still your annuity, it's still your money. You can take it and run. And if you pass away and never used it, the whole account value passes to a beneficiary, just as it was going to in the other place you were letting it set with no amplified long-term care value. So we have some really, really good long-term care options. the annuity care, indexed annuity care, Equitrust is bridge, right? Lots of great options for it. I probably dug into that a little bit more than I needed to, but I think it's warranted.
Question for you, Doug. So on that Global Atlantic with the benefit pool of $311,785, if you don't use it for long-term care, your $100,000 single premium is growing at what rate?
Depends on the interest rate when it's issued today. That's 5.5% or 6%. Right, so it's basically growing at the same rate as a MIGA, maybe a little bit better. That rate can come down. It's not guaranteed to be there, but they've done really, really good so far with holding true to that rate. And if you never use it, if you never needed it for long-term care, the entire account value passes to a beneficiary. And if you ever needed it down the road, maybe you're running out of other retirement money, it's your annuity. You didn't throw the money away to a premium for long-term care. Take it and run with it if you need to.
Right.
Don't necessarily recommend it, right? Because you're getting really good value out of it. But if you need it, you need it. So we do have annuities with long-term care values. And then one I think that gets overlooked quite often are the enhanced death benefits. I see a lot of people with old MIGAs. They're coming out of surrender, and people are just rolling them to new MIGAs. And their ages are 70 plus. And generally, those old MIGAs roll into new MIGAs at that age. The client doesn't want the money. They don't need the money. They never plan on using it. What they want to do is help it safely grow so they can pass it to their children at some point. And if you're going to pass it to your children at some point, why not just roll it into an annuity with an enhanced death benefit? Instead of getting 5-ish% interest, what about a 7% simple interest roll-up that's guaranteed for 15 years? It's a pretty solid option, right? What about a 20% bonus on day one? And that bonus increases every 5 years, or at year 5 and year 10, right? We have other great options to help your, I'm not going to say account value because it's not always account value, right? Sometimes it's a fictitious column, but that number that's growing is what will pay to a beneficiary. Now, it's important to pay attention, right? Sometimes they do have a rider fee. Again, if you're passing the money on, that may not matter. And then more importantly, some products will allow a lump sum payout. Others will require the benefit to be taken over 5 years or more in order to get that enhanced value. But we'll have a conversation about those and the options available if the need shows up with a client. We also have, as we showed up here, premium bonuses, right? You can also use a premium bonus as an enhanced death benefit. Right? If you've got somebody that you don't think is going to make it another 2-3 years, we can do some pretty big premium bonuses. And those premium bonuses, in most cases, are guaranteed fully vested on day one for the purposes of death. They're not fully vested if you want to reach in and grab the cash and run. But if you die, that money is there and it pays to a beneficiary out the gate. So lots of great options. We have other great strategies, thoughts, concepts that we can run with, dealing with RMDs and qualified distributions. The sky's the limit as long as we got an open mind and we can have a conversation.
Great. So, Doug, I got a question for you. There's a lot of carriers and options. When working with an advisor, what are the key features you need from that advisor to help identify the best solution for their client?
That's a great question. It's one of those things where, like, we've got those information, I don't know what you want to call them, information collection sheets, data. For somebody that wants a life insurance quote, you can fill out this thing of what you're looking for. We don't have that on annuities, but I believe it's because annuities can be so complex. Every client can be very, very different. So what do I need? Really, I'd love to have an all-out conversation. I'd love to sit down and talk. And based on kind of what you tell me about a client and how you answer certain questions sort of depends on where my brain goes from there and what I point to. But of course, at the basics, we've got to know male, female, age, how much money we're looking at, whether it's qualified or non-qualified, or any weird operations outside of that, 403B or inherited money. And if we want to go deeper, then give me a MIGA or give me the best 7-year S&P cap. I'd like to have conversations about what we really want with the money, what the expectations are from it. Even when we're looking at guaranteed lifetime income, right? A lot of times we'll come down and we'll look at these guaranteed income figures, and I may run a quote and see that the highest income is, I don't want to pick on a carrier or a product, but let's say the highest income is with a product that maybe isn't a great fixed indexed annuity. Maybe it's only really going to give you 2 to 3% interest each year. And that might be okay. If all you care about is guaranteed lifetime income, the highest possible income, then that's perfectly fine. But if the next best option is just a little bit lower in income, and maybe we can give you, say, an 8% S&P cap, a 9% S&P cap, if we can give you the ability to get returns that can possibly compete with and offset the entire year's worth of distributions, you might be willing to sacrifice a little bit of income to have that product, right? My mother's got one of those, and she just got 120% of the distributions that she took all year. All right. So now her account balance is higher than it was on day one. It's higher than the original premium, even after taking income for an entire year. All right. So if you've got a client that has kids and they like the idea of wealth transfer, they like the idea of trying to hold that account value together to pass it on or have some kind of access liquidity to it later down the road just in case they need it, those are conversations I like to have. If we're dealing with someone and we're having a conversation because they're having RMDs, they're starting to kick in, and maybe the RMDs are higher than the total income that they even want to take. Right? We can have conversations about how to use annuities to help offset some of that RMD, help kick it to a charitable organization directly and offset RMDs in other pockets so you can hold more money in a managed account. But I can't put all of that on a one-page flyer, you know what I mean, to collect data. We just have to have conversations.
Right.
And
right.
Once we have those kind of conversations enough, you probably got the same kind of clientele most of the time, and we won't have to continue having them. You'll just be able to run with what we typically do. But yeah, unfortunately, we can't just. You can just send me, Tom Jones is 55 years old. He's got $273,000. How much lifetime income can we get? You can do that, and I'll send you a quote. And I'm going to give you a couple of other options probably, and I'll explain those points in detail. And then maybe you come back and ask more questions. But it's up to you.
Great. Thank you, Doug.
Yeah.
As we wrap up, I'd like to remind you today's brew and entire library are recorded and shared on the brew page on our website at www.e4.insurance. Don't forget to subscribe to our YouTube channel to keep up with the Brewcast. They are released every Wednesday. Next week, the brew will be released at 10 a.m. Central. I will be joined by Greg Short, who's Regional Vice President at Mass Mutual, to discuss their key features with Mass Mutual products. Thanks, everyone, and we will see you next week on the brew.